All right. Looks like I'm live. Dun, 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 dun. Looks like I'm alive. I'm live on the BMT Be More training using StreamYard once again. I'm waiting till somebody pops on. Seeing somebody pop on. I'm doing my quick little audio test. Can whoever you is out there, can you hear me? Talk to me. I got about 2 minutes before I start, so I just want to make sure we're good to go. We're good to go. What's going on, y'all? What's going on? I got about 2 minutes before I kick it off. Oh, we got 4 people. Hell yeah. All right. So can any of you guys hear me? I'm going to do a quick little camera adjust. Working on my ability to adjust this damn camera from a distance. I got it all set back there. All right. That's better. That's better. All right, cool. Can y'all hear me? Boom. Ruben was popping, was shaking. He can hear me. Okay. Perfect. That's what I like to hear. All right. So what's going on, y'all? Now I'm going to start really abruptly too in like 30 seconds. But I want to kind of give you guys an introduction of what the hell we talking about today. And we're actually going to be talking about loan products. Loan products. Many people are sometimes often confused about the different type of loan products. I'm getting my notes pulled up here. And essentially how they work, right? An LLC loan versus a personal loan is really what we're going to focus on, okay? That's what we're going to focus on. So for anybody who is new to the channel, anybody who's new to what Be More Training is, what Ruben and I put on twice a month, is essentially an education platform for us to share with you different insights within the real estate profession, whether you're an investor or you're an agent, but also for the small business owners out there as well, because you guys can take a lot of this information because it just correlates very well. All right, boom, 9:30 on the dot. So today we're going to be talking about loan products. All right. Now, for those who don't know me, spent several years as a real estate investor, real estate agent, and now I also work with MC Mortgage Group as a loan officer. And so a question that comes up to me often is what's really the pros and cons of getting a loan in an LLC versus getting a loan in your personal name. So that's what we're going to talk about today. All right. Now, typically when we're talking about an LLC versus a personal name, we're sticking within the realm of 1 to 4 units in the single family space, residential space. Because if we were going to move over to a property such as storage center, retail center, office building and things of that nature, that's typically a commercial space. All right. So we're going to need a commercial loan for that. And typically you'll need to put that in an LLC. So we're not going to touch on that. We're going to talk about the pros and cons of that single family space, meaning 1 unit all the way up to a quadplex or 4 units under one roof. Okay. As we're going through this thing, if you guys got questions, comments, concerns, slap it in the chat because I can see all of it. I can see all of the chat box on this beautiful thing. This again is StreamYard, y'all. This is a dope platform because it allows me to stream on. I'm on like 8 different things right now, so it's cool. All right, shout out to Ruben for that. All right, so first thing we're gonna do is we're going to break down the definition of essentially an LLC loan and a personal loan. And I'm not going to go Wikipedia on you, but I just want you guys to understand the concept here. Okay. A personal loan is anything in your name. That's it. So if I went out and I said, hey, I want to buy this home and I'm going to get a mortgage, and that mortgage is reviewed and recorded and the deed is recorded in Mike Glaspie's name, that's going to be a personal loan. Okay. An LLC is essentially that. It means the deed is recorded and the loan is going to be produced under the LLC name, right? And so let's just call it a Glaspie Enterprises LLC, hypothetically. Okay, so that is the primary difference there. Now, when we think LLC, I want you to switch into your brain and think commercial loan. Okay, the terms, the underwriting requirements, and all that stuff mirror commercial loans out there. But more importantly, the concept of commercial, for the sake of this loan product, is it's simply business to business lending, okay? Instead of business to person lending. The business would be the mortgage officer, the loan officer, the bank. That's the business. Giving a loan to who? If they give it to me, it's business to personal. But if they give that loan to an LLC is a business. And so because it's B2B, business to business, it becomes a commercial loan, okay? So the commercial loan, the LLC loan, they're worried about the asset. What I mean by the asset, I'm talking about the property itself, okay? They're worried about the actual home, the four walls, the door, the foundation, the home. That's really the underlying value proposition for them. Whereas if I'm getting a loan in my personal name, they're worried about me, my ability to make that payment on that loan. Okay. So they're going to scrutinize me a lot more than the property. All right. So hopefully that makes sense as far as the difference between commercial and personal. And now we're going to actually talk about what that personal loan consists of. And guys, just a quick question for anybody listening. How bad is that squeak? How bad is that damn squeak, man? It annoys the hell out of me, but I'm always concerned that it annoys the hell out of y'all. And I don't want that. I might need to put some WD-40 on it or just super glue it together. And hopefully y'all don't listen. Oh, we got a face on there, so it's probably bad. Sorry for whoever it's annoying. Okay, Ruben says it's not bad. All right, cool. All right. Now I feel better. But to me, I'm just like, grinding my teeth. Okay. So we're going to hit off with the start with personal loans. All right, this is where we're going to be at. A personal loan. Again, remember, that's about me. That's about me or you. In this instance, you and your name. What are some types of personal loans? So if you guys can think of some ideas of a loan type, and I'm going to give you an idea real quick, a VA loan. A VA loan, Veterans Affairs loan, that's a personal loan because they're lending against the person. Give me some other ideas of personal loans in the chat box here. Anything you can think of. VA is one example. Give me something else. All right. Now, while you guys are putting that in the chat box there, let's talk about what is involved with a full personal loan. They're looking at you and your entire financial background. Okay. Your entire financial background. So they're concerned about your taxes. How much did you pay in taxes? How much do you make, right? Your income, your gross income. They want to know, hey, where have you lived for the past 2 years? Hey, where have you worked for the past 2 years? And have you been in the same type of business for at least 2 years? Or is this a new field for you? They want to know all of those things, right? Boom, FHA, USDA, conventional, new construction. That's exactly right. Those are all types of personal loans. And so for any of these, they're worried about all of this information. Now, on that same note, VA, FHA, and USDA are also government-backed loans. So conventional is a personal loan that's just between you and the bank. Those other three examples are between you and the bank and a government entity, which just means what? More red tape, more paperwork. That's all it means, right? And you have more qualification requirements and things of that nature. Now, typically, if you can qualify for one of those other three, FHA, USDA, and VA, then you can qualify for conventional. You're just trying to get a lower down payment. Fair enough? All right. So the requirements as far as how they underwrite you are still the same. They want all of that. Like I said, taxes, 2 years. Income, where are you getting it from? Where'd it come from? Is it seasoned? Has it been in there for 2 months? Job, have you worked at that same field for at least 2 years? So forth and so on. Full doc review, okay? So that already, is going to be a little bit more time intensive and a little bit more scrutinizing because many of you may have just switched jobs. COVID hit. COVID was a beast, man. Some of you may be self-employed, right? So now you can start to see some of the barriers for the personal type of loan. The next barrier is what we call debt to income. All right. And essentially, all they're worried about is your monthly debt to income. And they're looking at your fixed debts that actually show up on your credit report. So many people ask, is gas a debt? Is daycare a debt? That's a good one, right? Is daycare a debt? Is my Netflix and things of that nature a debt? None of those actually reflect on your credit report. Okay. The debts that we're talking about are going to be your mortgage, your car notes, student loans, credit cards, and the like. All right. Things where you actually have to apply for credit to, to actually get it on your credit report. So utilities, that doesn't count. Okay. Things like that does not count. Now that we know what debt is, essentially, now we're going to take our gross income. How much are we making a month? How much are we making a month? And now we're going to compare the two. We want to make sure the ultimate magic number, and when I say magic, I mean absolute max, right, is 50%. A bank is going to look at you sideways if you're anything over 50% debt to income. All right. So hypothetical scenario. Let's say you make $5,000 a month. You're making $5,000 a month. Your debt payments, that means your mortgage, your car note, your student loans, your credit cards, all cannot exceed $2,500 a month. Does that make sense? 5,000 is what you make. It cannot exceed 2,500 or 50%. Now, there are going to be some cases where, a loan officer we can get real creative. We can say, hey, look, based on this sale of the property, we're going to reduce this mortgage. We can take the proceeds and pay off this. Clack, clack, clack. Boom. Now we just increased your buying power. We can say, hey, let's refinance and consolidate. We can do all that stuff, but just understand that your debt to income at 50% is max. Okay. Ideally, you want to be somewhere below 40%. If you're below 40%, you're going to get approved much quicker. And we're also worried about your credit report or your credit score, which we'll talk about in a second. So Ruben says, question time. Blah, blah, blah. And if y'all have questions, just drop it in there, guys. It helps me feel like we're actually interacting instead of y'all just looking at me. All right. So what's a debt that is a misconception to buyer clients? In other words, buyers are worried about this debt, but in fact, it's not debt you look at as a loan officer. I'm trying to think, because many of them are going to be more like the utilities. They're going to think of monthly expenses, variable expenses, put it like that. They think are debts, right? And so that may be phone bill, right? Utilities, groceries, gas, things of that nature. So it's typically buyers think that because I pay this every month, this is considered a debt. All right. That's the typical misconception. But ultimately, it's whatever is tied to your credit report. And so the reason that question is difficult to answer only because every scenario is different. Out of all the buyers and borrowers I've talked to, many of them will think that a different expense is something else. Here's one that typically does not get thought of, and it doesn't show up on your credit report, but it is considered a debt. It's child support. So that I just flipped the script on you now. I remember how I said typically it's on the credit report, but child support does not reflect on the credit report. But because it's court mandated, then that is a debt that many people may overlook. So that's a good one there. Okay. So, or alimony. Alimony and child support are considered debts, right? Even though they may not feel like it's a debt. And there's probably a much bigger list that if I was prepared for that question, I should have been able to answer more in depth. But again, it's case by case. All right. Maybe commercial notes on an LLC. Facebook user. That's all it says for your name. So I'm sorry, but explain that question a little bit more for me. Maybe commercial notes on an LLC. What exactly about those commercial notes are you interested in? Are you talking about terms and conditions? Just kind of explain it a little bit more, and I'll dive into that. All right. Oh, what's up, Mark? What's up, man? Yeah, it just says Facebook user, bro. I don't know what's going on. Anyway, all right. So explain that a little bit more for me, and then I'll answer that question for you. All right, so we talked about the DTI. All right, so the next and the final one that I kind of wrote down as far as limitations go is understanding that you can only have 10 loans in your personal name. That's Freddie and Fannie, that's the big government service entities, the GSCs, that's their limit on how much you can have in your personal name. Now, many of these regulations are put in place due to some of the past activities that we've had in 2007, 2008, 2009. Excuse me. So these are their measures, right? In a personal loan, there's a lot more restrictions and a lot more guidelines on how you need to be underwritten because of some of our past discrepancies, right? So understanding that, hey, DTI is going to be a factor. And now on top of DTI, I can only have 10 loans at one time in my personal name. Now, the way around that, guys, is let's just say you're buying rental properties now, because typically people don't have 10 primary homes. But let's say you're buying rental properties, you're trying to continue to put them all in your name. At any point in time, you can decide to pay off the debt completely of one. Let's just say you're at 10 now, and all of a sudden the debt goes away for one. I can't do, my hands are, anyway, hand goes away for one. Let's do it this way. Then you have the ability to go out and get another loan, because 10 at one time is the max. So there's some strategies there, and we can have that conversation if you're interested about how to shuffle those properties around so you always have 10 or you're always at your max. But understand that debt to income will always supersede the 10 on your max, right? So most people can never get to 10 because their debt to income can't support it. That makes sense? Let's go back 1 second. We talked about how debt to income has to be 50%, right? I mean, that's absolute max. So hypothetically, if you have 10 properties and the mortgage is $1,000 for each property, that means your monthly debt just for those mortgages, just for those properties, is $10,000 a month. If that's your debt, that $10,000 has to be half of what you make every month, which means you have to make $20,000 a month to support it. So you can quickly see how most people will not be able to afford 10 properties. Because to be quite honest, $1,000 is fairly low for a mortgage in certain markets, right? So just understand that concept. DTI always supersedes the 10 amount, but those are going to be your limitations there. All right. Now I'm going to go back to the question that Mark had. All right. So maybe commercial notes on an LLC that may pop up on debt. LLC commercial notes popping up on your DTI or credit report. Beautiful question. And we're actually going to talk about that on the LLC, but I will touch on it right now. The best part about an LLC is an LLC has its own social security number. All right. It's called an EIN, employee identification number, employer identification number. That EIN is what reports to the IRS. So when you go out and you get a loan, and you get a loan in a commercial asset, it's actually tied to that EIN, not your social security number. So when your credit report pulls up, your credit report is for your social security number. It's tied to you. So the commercial loans are not tied to you and your personal credit report. It's a beautiful thing. It's a beautiful thing. All right. So that's the answer, Mark. Hopefully that answered it. But again, we're going to get into that a lot more in depth when we jump into the commercial side of the house. All right. So wrapping up the pros and cons of the personal side. A pro, always remember this, because it's you and they're looking at you and they feel good about you and they've done all of this research on you. Remember how much detail they need. They're going to give you lower interest rates. 9 times out of 10, you're going to get lower interest rates in your personal name. That's a beautiful pro. All right. The con, right? The downside to a personal loan, again, goes back to your debt to income. You have to be able to support it. And then ultimately, even if you could, you're limited to 10 properties. All right. That's the con. Not a bad thing, especially if you're only looking to buy 2 or 3 homes. You may be able to get them all in your personal name. Not a problem. You may be able to lock them all in at low interest rates. Okay. Next, we're moving over to the LLC loans. If you guys have any other questions, let me know. Let me know. And hopefully that answers your question, Mark. We're about to jump into this. LLC loan. What's an LLC loan? It's what I just said in the beginning for those who are still here. But it's essentially business to business. That's what I want you to think of. Now, what type of loan products fit into an LLC loan? Remember, we talked to VA, FHA, USDA. Those are all personal. Go ahead and put into the chat real quick. What are some commercial loan products out there that you guys can think of? And I'll answer a few in a little bit, but go ahead and put them in the chat box there. So when we're looking at LLC loans, we have different loan products, which we're about to discuss. And what they focus on is they're not necessarily worried about you too much, right? Remember, we told you on the personal side, they do a full body cavity search on everything that you have, right? With an LLC loan, they are going to review you quickly. They're going to obtain your credit report. They want to make sure that you don't have foreclosures, that you don't have missed payments and things like you are a good borrower, okay? And also your credit report, they do have a minimum credit score requirement, but they're also just going to see, hey, if it's really high, we may give you a better interest rate. But that is pretty much all they're concerned about when it comes to that aspect, right? They also may be concerned with your experience, right? If you are going to do a big construction project, then, hey, maybe you need some construction experience or some flipping experience, okay? So they're worried about you a little bit, but they focus heavily on the asset, okay? So I see y'all didn't put that in the chat box, but it's okay. So we're going to talk about quickly loan products in LLC. We just talked about big renovations. Any type of fix and flip loan, if you hear that term, fix and flip, that's typically an investment product. It's going to be very common in the commercial space. All right. Bridge loan just simply means filling the gap between point A and point B. There's many different terms of that, if you will, but bridge loan is typically a good commercial product. Construction loans, just like you had on the personal side, you have construction loans in a commercial product, basically owned and operated by the LLC. Yep, Mark put in there portfolio loans. Absolutely right. A portfolio loan could be one of two things. It could be a blanket loan, if you will, over multiple properties, one loan over multiple properties, or it can be an internally generated and serviced loan. Meaning, if you came to me, hypothetically, we don't service our own loans at MC Mortgage, but you came to me and we said, hey, look, MC Mortgage is putting up the money, and then MC Mortgage is actually servicing the loan. That could also be considered a portfolio loan. For those who don't know, quick sidebar, typically what happens is you're going to have somebody sell the loan product or represent you on the loan product. Could be a loan officer or a loan broker. Then you're going to have somebody that's the representative. Then you're going to have somebody actually make it happen. Let's just call it UWM, doesn't really matter, right? They'd service it. And then that person who does that sells the loan to actually be serviced month to month for the final 30 years. So there's typically 2 or 3 people involved in a loan transaction. So if you have one person, one entity, let's just say Bank of America, give you the loan, generate the loan, and service the loan, all 3 under one roof, that could be called a portfolio loan. Just a little nugget for you. Just a little nugget. All right. So let's get off of that real quick. Let's go back. A quick review on you. Big review on the asset. That's the difference. Big review on the asset. So there's 2 things that they're worried about for a commercial loan. They're worried about the appraisal. Okay. They're worried about the appraisal. Then they're worried about something called debt service credit ratio. I'm going to see some DSCR. Let's see if that worked. Oh, yeah. So my name is proven by Ruben in the chat box, but it don't matter, guys. That's it. DSCR. I just wanted to see what would happen if I chatted. All right. So check it out. Every property is going to get an appraisal. Every property is going to get an appraisal. Why? Because a loan is going to give you a certain amount loan to value. VA will give you 100% loan to value. An investment loan will give you 80% loan to value. Some other ones, 70%, so forth and so on. What is the value? How do they determine the value? It's by the appraisal. Okay, excuse me. So the appraisal is going to say, hey, look, here's the purchase contract price. Here's the appraisal value. We're going to give you a loan, 80% of whichever is less. Okay. Understand that. Why do they do that? That's how they protect themselves. Would you just go out and if you were a bank or if you had money, would you just give everybody 100% financing and just risk it all? No. They would be out of business. Okay. So understand that concept, because it's extremely important to understand that an appraisal will always be required for a loan. Sometimes there's drive-by appraisals, desktop appraisals, full appraisals, market rent appraisals. Don't worry about that. I mean, there's different appraisals for sure, but there will always be some sort of appraisal required for a loan. Okay. Now that you understand that, how do they value an appraisal? An appraisal is based off of comparable sales approach 9 times out of 10. They're going to look at recently sold comparable homes. So 3 bedrooms compared to 3 bedrooms, not a 5-bedroom compared to a 2-bedroom. Okay. They're going to look at recently sold comparable homes to determine market value. Now that's a beautiful thing. Everybody understands that concept generally, but in a commercial loan, that's just the first step. We say, okay, great. We understand the market value. That's our baseline. The next piece is the debt service credit ratio. The debt service credit ratio says that, hey, whatever your monthly debt is, that's your full pity payment, your mortgage, your principal, your interest, your taxes, your insurance, and your any other HOA or anything like that. Those things are all going to be calculated up. Once we understand what that debt is, we need to be able to exceed that in whatever the market rent is. Typically, it's by 25%. All right. So what does that mean? That means if you had $1,000 a month mortgage, typically we're going to want to see that you're coming in with $1,250 of income, $1,250, because that will be 25% more, $250 more than the debt. The way that is articulated, okay? The reason that's important is because, great, you have this purchase price, it appraised for this, cool. All that's fine and dandy. But as soon as we get the market rent analysis and we understand how much money comes in, if it does not meet that DSCR, well, we're going to have to bring that price down, right? So think of it as a 2-factor authentication when it comes to commercial real estate. And it's extremely important for you guys to understand that. And I'm going to tell you why in a second. But first, I want to answer Ruben's question. How does your brain hold all this info, real estate sales info, investing info, et cetera? This is bonkers. It's just, I mean, I've lived this life now for 6 or 7 years, all day, every day, same conversation, studying, all that good stuff. So it's in there now. It's like a encyclopedia of numbers. You know what? So it's fun, stressful, fun, but it is fun. So I'm trying to hopefully make it entertaining and knowledgeable for you guys. All right. So I want to talk about this DSCR here. So think of it as 2-factor authentication. This right here is the piece that I need everybody here to focus on. I need everybody to understand the concept. You do not have to be an expert. If you guys have questions about commercial properties, give me a call. We can go over it together, and I'll run the numbers for you. Take that with a grain of salt. Don't just be sending me deals, y'all. Don't be wasting my time. I'm a busy man. But seriously, the concept is extremely important. We talked about having to bring down the price to meet that DSCR. It's a 2-factor authentication. Because it's a 2-factor authentication, right? We have to get the appraisals to determine the DSCR and the appraisal value. When do you think we can actually give a full pre-approval letter to the borrower? That's the question. That's the question. In a personal loan, I can give a full pre-approval letter way in the beginning. Why? Because I just evaluated you and your entire lifestyle all the way in the beginning. You gave me all the information I need, and I know exactly what your income is. I know how to not exceed your DTI, your 50% DTI. I got all this information. I can say, hey, look, you are approved up to $200,000. Here's your letter. But on the commercial side, remember, I can't approve shit until I have the DSCR and the appraisal value. So the way it works on the commercial side is we'll do a brief overview of you. We'll obtain your credit report. We'll obtain all that stuff from you. All right, great. We're going to say, okay, based on your information and your liquidity that you've proven to me, the cash that you have, we can approve you up to this amount. We can qualify you up to this amount, but we have to view the property. So you go out now, you say, okay, I can purchase $200,000 worth of property. Great. You go out there, you find the property. We're going to put in the property's information based on what we know, and we're going to give you an initial term sheet, an initial loan terms, this LTV, this interest rate, so forth, based on the property now and a little bit about you. You're going to sign it. You're going to do all that. We're going to order the appraisal. We're going to do all of that stuff. And at the end, after we have the appraisal report and the income and all that, and then we can calculate the DSCR, sorry. Now we're going to do a final review. And now we can give you a final term sheet at that point in time and tell you this is what the final loan product will look like now that we've done our full two-factor authentication. Okay. Again, I just really want to harp on that, because many people will think that they can get fully pre-approved for a commercial loan like they can on a personal loan. And they'll come and they'll ask, how much am I approved for? How much can I afford? It's a very delicate situation, because I don't want you to go out just thinking that you can just say, hey, here's a blank $200,000 pre-approval letter that I can put at any property, because the property is so important. Okay, so just keep that in mind. All right, so we're going to talk about the last little piece here, guys, and I'm opening it up for Q&A, but now it's the pros and the cons. I'm still here. No, I'm still here. This camera. I got my own little issues with this bad boy. Let's see it pop in. Give me a second. Give me a second. This is that part that I'm working on. And see, I put my hand out here and I just focus on my hand, and then that generally works. See? Practice, guys. Practice makes perfect. Okay. All right. So let's talk about the pros and the cons. So the pros primarily for a commercial loan is that there's no limit on how many commercial loans you can have. Y'all hear that? Pop up. There is no limit on how many LLC loans you can have. There is no 10, no 5, no 20. You can have 1,000. No bullshit. You can have 1,000 LLC loans. And the reason why is because we don't care about your personal debt to income. We only care about the property's ability to self-sustain. So if you're buying intelligently, yes, you will need your 20% down payment. Got it. But you can have an infinite amount of LLC loans. So that's a powerful pro. The next thing is that it's an asset protection. What do I mean by asset protection? For those who are not aware what LLC stands for, it's a limited liability company, meaning it limits your personal liability. Okay. Meaning, let's just say I'm here. I got the microphone here. Sorry, guys. I'm here. LLC is here. If somebody was living and renting in my LLC and they decided to sue me, they can only sue everything the LLC owns. They can't touch my personal stuff. They can't touch my retirement account. They can't touch my kids' college fund. They can't touch my personal home. They can't touch my blah, 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 because it's an LLC. It limits my personal liability. Okay. So that's asset protection. And we can go more in that if you guys have questions. The next pro is that there's no reflection on your personal debt to income. This goes back to Mark Horton's statement or question about how does commercial loans affect you? If it truly is a commercial loan generated by your company, then it will not reflect on your personal credit. Here's what some people do. Some people will say, hey, look, I don't have any business credit, so I'll go out and I'll get a personal credit card and I'll use it for business. And I will tell everybody in the entire world that this is my business credit card. Now, there's nothing wrong with that. Tax purposes, again, I'm not a CPA, but I've done it. As long as you're using that card for strictly business, it can still be business deductions. You can get all the tax benefits. The problem is that the way it was originated. You originated it in your personal name, so it's still tied to your personal credit report. It will still reflect on your debt to income. Now, again, get with a good loan officer, and we may be able to take that and reflect it differently on your DTI if we know that it's all business expenses and we can prove it. Perfect example. Some people, Ruben, you might like this one. Some people will own a business vehicle, that was owned and bought by their business, even though it's in their personal name on their tax return. Well, when we look at your tax returns, and you can prove that it's actually a business vehicle, well, we can take that expense off. And so now it reflects on your DTI, right? So again, it's just having those conversations with those loan officers and let us help and guide you through maximizing how much you can afford. Okay, so those are the pros. No reflection on the DTI, asset protection, and then no limit. Now, what are some of the cons? So because it's asset-based, all right, and we're only focused on the asset, and most of the time, these assets are not occupied or they're not making money on the time of purchase. So because of that, and we're not having, the full scrutiny of you, you're going to have higher interest rates. Now, they're not crazy high. Let's just say a personal investment loan can be around 3.6, give or take, right? 3.6, and it'll change by the time you guys review this or whatever, because it changes all the time. Investment loan. Whereas on the LLC side, it might be 4.5, 4.2, depending on how strong of a borrower you are, your credit score and things of that nature, right? So we have to be aware of that. But understand that it's just slightly higher. Now, a lot of people will be like, oh, I'm not paying anything over 5%. I caution you to actually go and study the history of money, because you'll realize that 5% is still historically low in the grand scheme of our financial structure here in America. The 2%, the 3% is insanely low. So get as many of those as you can. I'm not going to lie to you. All right. The next a con for an LLC is just a higher down payment. So where we talked about VA would be 0 down payment, FHA would be 3.5% down payment, USDA would be 0 down payment, and even a conventional personal home that you're living in would be 5% down payment. When we flip the script and we start talking about investment properties, there's some creative ones on the personal name side that we can do, 10% down, so forth and so on. But typically, not all the time, but typically on the LLC side, you're looking at 20%. And I want you to understand that even if you got an investment loan in your personal name, 9 times out of 10, it'd be 20% there too. But an LLC is typically only used for investments. You're not, and I'm using the word typically because there's always a lender out there who's going to do something crazy. There is, right? I actually know a lender who would do an LLC for a primary home loan, although I've never used them, but they said that they could, okay? But 9 times out of 10, you're going to see LLCs as being investment only types of funding. So because of that, you're going to have a higher down payment. And so now when we talk about the ability to scale and grow your rental portfolio, which many of us want to do, or real estate professionals who are saying, hey, I have a client who wants to buy multiple homes. How can I get them approved multiple times over? It's going to be a lot easier to do that when they're doing anything from 0 to 5% down. It's going to be a little bit more challenging when they have to bring 20% every single time, because they're just restricted to their ability to make more money, is what it comes down to, okay? And then the last piece is it's typically an investment-only product, although, like I said, there are a few lenders out there that'll do an LLC and a personal loan. I haven't used them yet, but I can call them if you guys are interested. Just saying. All right, guys. That's 35 minutes of me just rambling. What kind of questions y'all got? Hopefully you guys learned a little bit about the difference between personal and LLC, okay? And just understanding some of the pros and cons. Big moral of the story. You can always find financing. I want that to be very clear. A lot of people will say, I can't get financing. I'm non-lendable. I don't have a job. I don't have any income. And all those hypothetical scenarios, that's all bullshit. You can get financing. The question is, are you going to like the terms? Are you going to like the down payment? Are you going to like the interest rate? Are you going to like the length of the period of the loan? And oftentimes, depending on how rough your credit score is and things of that nature, you may not like it. But hey, it's part of the puzzle. Okay, what kind of questions do you guys have? And if y'all ain't got nothing, I'm gonna let y'all go. We working today, we grinding. And if ain't nobody got any questions, I'll let you know. Oh, here we go. I was about to start ratting on myself. No, I'm playing. All right. Do you absolutely have to have a business credit in order to get pre-approval for commercial loan? Great question. Great question, Mark. He says, I'll repeat it. Do you have to have business credit in order to get pre-approved for a commercial loan? The answer is absolutely not. You do not need business credit whatsoever. The reason why is because, again, we're worried about the asset's ability to self-sustain, the DSCR, income versus the debt for the asset. We're only going to review your personal credit essentially to determine what interest rate we're going to charge you. Fair enough, basically, right? To make that very overgeneralized. We're going to review your personal credit to determine what interest rate we can charge you. Most people are actually doing special purpose LLCs solely for the purchase and holding of a property. That's what they're creating those LLC for. And so the lenders are very aware of that. They're aware of the asset protection side. So they're still going to be able to produce that loan on that property without you establishing business credit. Now I'm going to flip that on its head right quick and let you know that if you wanted to apply for specific loan types, an SBA loan, Small Business Association or Administration loan, business lines of credit and things of that nature, that's a different story. Yes, we will need some credit history essentially for the business for those to qualify. All right, what other questions you guys got? What other questions you guys got? Send them. Send them. So I'll take these last few seconds here. I want to thank Ruben Garcia here again for this StreamYard. Hopefully you guys are enjoying the way that we're delivering Be More training now. It's populating on multiple platforms so people can get it consistently in the same place. And it's really awesome. I mean, it's just one thing. This thing is super legit. So I appreciate it, Ruben, for you kind of taking the leap of faith and giving this a test run. If you guys are enjoying it, just let us know. If you're not enjoying it for whatever reason, weirdos, no, I'm playing. But if you're not enjoying it for whatever, just let us know so we can always try to find ways to improve how we deliver the content. Also, on that note, guys, if there's something specific that you want to learn about, please let us know, right? And allow us to kind of prepare it on your behalf, if you will, right? But prepare it and kind of customize some of the training for you guys. Like I briefly mentioned, and it's not, Ruben has a lot of experience in this entire industry. I have, different points of view, different experiences, but there's no way that we can have like total recall of everything and be able to share everything within 30 minutes to an hour. So if there is something specific that you want to learn about, if we know it, or if we have that experience, we can share that experience with you. And if we don't, we can get somebody who can. So just know that, man, we're out here trying to provide value however we can. In addition to that, shameless plug, I don't care. I'm on TikTok now, guys. I'm ticking and talking. Tick-talking. All right. So go on there, give me a follow, hit me up on Instagram. Obviously YouTube channel, Military Cash Flow, if you guys are interested in that as well. Yeah, man, that's it. Shameless plug. I don't care. I'm on here. I got your attention for a little bit. We got a few users left. All right. But look, if you guys ain't got no questions, we'll let y'all go. We'll let y'all go. Fair enough. All right, y'all. Hey, enjoy the rest of your day. Hope you guys had a good time, and I hope you guys have a productive week. All right. And we'll talk to you guys soon.